Firstly, it's important to structure your assets wisely. It is a complex area. We've got different places where we can have our money, personal assets. We can have it in our own names, where tax rates are up to 46.5%. We've got company investing companies and tax rate up to 30%. Self-managed super funds and superannuation. And we've got family trusts and so on. So it is a complex area. There will be a lot. Well, there have been significant amount of changes that have occurred in just the last 2 years. There will be significant amount of changes coming moving forward, especially when we look at how we're going to pay for this stimulus just to keep the economy going as well. So the one thing that I would say is to have the right structure in place, firstly, but even before that, if you're not sure, go seek advice and go chat to someone. Give David a call or give Ian a call or Kat and say, hey, look, I'm looking to do this. Does this sound right? Or is this the best place for me to have my money? Because the consequences of not having it right are significant.
And very hard to unwind, if I'm correct.
Absolutely. And certainly both David and Ian have a lot more experience in unwinding things like that, especially from a business perspective as well.
Get it right first time, David and Ian. Is the key.
Isn't that and it's old-fashioned that also a pound of prevention is better than a ton of cure type affair. So you get it right to start with. It solves a lot of issues.
Yeah, true. Good points.
So one thing that we can do, especially in the current environment, is smooth the purchase price. So dollar cost averaging, and that is that along the way, be able to take advantage of the dips and downturns and buy assets at a much lower price than what you'd bought them previously. And here's an example. So the one place where this happens quite often and that most people do not, or they're not aware of it, is your superannuation. So your superannuation dollar cost average is quite simply because your employer contributions, or you put in contributions, and your contributions may be going in monthly, they may be going in quarterly. Quarterly would be is the way that it's supposed to be going in, or less than that. And so they go in on a regular basis, and you're buying those assets on a regular basis, and you dollar cost averaging, meaning that you're buying these assets at regular intervals, whether they're up or they're down. And what you end up having is an average price, much like that line there, which is a smoother ride. So that's one strategy that you can undertake, and that's something that, as an example, the clients that I was speaking about earlier that have written in and saying, look, we're looking to take advantage, where we have been able to buy over the course of the last 3 months, and if you then look at their average cost base, the average cost base has been lowered and their average price is significantly smoother. Take advantages of the benefits of compound interest. So from little things, big things grow. And this here is a difference between an active, well-managed fund versus just the market return. And so what you'll notice is that since inception, and the value of $10,000 invested at launch of this fund, we've seen that there's been 3.5% higher than market return year on year. Now, 3.5% doesn't seem like much, but it's what that 3.5% does. And what you'll see is that compounds to 4.4 times more wealth in dollar terms.
That doesn't sound like much until you say the actual number, from 800,000 to 3.6 million. That's a big jump.
It's certainly a big jump. And it's one of those things where, we don't take too much notice of it, but it makes a significant impact to your wealth. I will, and this sort of ties into the next slide as well. Well, the next slide, where it says take care of your nest egg. But I'll pause here for a moment, because the one thing, and I spoke about this a number of weeks ago in relation to people that have drawn money out of their superannuation and the $10,000 that they've taken out of their super fund. $10,000 this year, and they'll maybe take out $10,000 early in July, August. That will, depending on your age, will have a significant impact to your financial wealth. And look, I can completely understand, because I do have one or two clients where they had no option but to. But then there's certainly other people that have said, oh, look, I have access. In fact, I got a phone call from a client saying, look, somebody at work's taken $10,000 out of their super. Should I take out $10,000 out of my super and put it against my mortgage? And I then explained to my client that one compounds downwards, and especially from a very low base. So as an example, he's paying no more than 3.5% for his mortgage. One's going to compound downwards, whereas the other one's compounding up. And once I'd explained that to him, it was a no-brainer. Everything stayed as is. But it's just something to be aware of as well.
I love that slide, because it's only 3.5%. I've been with you when clients have said things like 3.5 doesn't sound like much.
No.
Makes a massive difference. What do you start to do to see that 3.5%? That's above the market. So that's active management, quality investments.
Quality investments. It's as an example, the discussions we're having with clients at the moment. So, David and Helen this morning, and there are other clients along the last week. When you compare. And it's not just about the investment returns, and this is one aspect of planning as well. But it's about making sure that you have the strategy correct. Once you've got the strategy correct, it's then about this is the icing on the cake, because as we mentioned before, if you have this, but you have it in the wrong structure, well, that's going to hurt as well. So you've got to have all the layers right. And in this case, where it does make a difference, and the discussions that we've been having is, well, okay, look, the market has done this, but your portfolio has done this, and this is why it's better off as a result.
So just while we're on that, Tony, sorry, I just got a question from Renee, specifically what you're talking about there. What about investing in shares or assets with the $10,000 you take out of super? Could you be set up for a better return? I think that's a wider discussion, but I'll let you answer that one.
Yeah, look, I was actually going to say it depends, and the answer is it doesn't depend. It doesn't, and the one thing that would need to be taken into consideration is tax rates. So there's advantages of investing money outside of super, advantages of money inside super. Outside of superannuation is that it's accessible. So all of a sudden the car blows up, I can take $10,000 and I can help repair it or whatever the case is. Inside super, I don't have that access. But one thing that I do have inside super is a significantly lower tax bracket. So from a tax perspective, unless you're in the you're not paying any tax or up to 15%. Having money inside super is certainly beneficial from a tax perspective, quite simply because the lower tax threshold is more beneficial for you.
The last part of the question is, would it be better return?
Oops, sorry, just me.
You need to check your whole strategy, because it depends what's your super investment strategy as well.
Sorry, mate, we just lost you there. You may just need to repeat that little bit again.
Okay. The second part of the question was, could you get a better return outside of super? I'd suggest that's the investment strategy. It doesn't matter. You can invest inside and outside of super. Your return's based on your strategy. So it's time for a review, isn't it?
Yeah, absolutely, absolutely, and it comes down to the assets that you're able to purchase within super. Now, it depends where your super is as well. There are some super funds that don't quite have the assets that you may be able to invest outside of super, but then there's some super funds that have they have a wide array of assets that you can purchase, and you can purchase almost everything. So there's certainly advantages of within super, and the one thing, Renee, I'd say to you is pick up the phone, have a chat to someone, and they'll be able to sit down and look at your circumstances to say, well, okay, look, based on what you're looking to achieve, this is ideal for you.
Yeah, thanks, mate. I picked Renee then because it was the top one, but 3 or 4 popped up at the same time, all very similar. So we'll address those. Thank you.
Taking care of your nest egg. So wealth strategies take care of your nest egg. Super is an investment vehicle in a tax-effective structure. So tax at concessional rate of 15% versus your marginal rate. And super is a primary source of retirement income for most Australians. So something just to be aware of, we're sitting in June. We've only got a number of days left, of working days left before the end of the financial year. Are we maximising our superannuation contributions cap? I won't spend too much time on what that is, but if you know what that is, certainly have a look at it. If you're not sure, pick up the phone and chat to one of the experts here. They'll talk you through it. And there's some really good things that can be done, including catch-up provisions as well. Once again, I won't go into that. That's a whole topic by itself, but that's something just to be aware of. Pre-tax contributions and after-tax contributions. Once again, I won't spend too much time on this slide either, because I do want to leave some time for Q&As as well. Not all debt is bad debt, and one thing to be aware of in the current environment is we are sitting in an extremely, as I've said earlier, a low interest rate environment. So borrowing is cheap, and it comes back to cash flow. But can we replace inefficient debt, non-tax deductible debt, with efficient debt on a regular basis? And can we use the income and tax advantages from leveraging to further reduce inefficient debt? There's some strategies in place that we can utilize to debt recycle as such, and reduce your non-tax deductible debt, non-deductible debt, sorry, and increase your deductible debt. It's got to be right for you. You've got to be there's got to be enough income and cash flow to be able to support that. But these are just strategies to help you take advantage of the current environment that we are certainly in.
Debt structure in particular, Tony, I love when you guys, and I've heard Kat and Ian particularly Ian talk about this a lot too. Who's setting your debt structure or your debt plan? Is it the bank or you? That's a fantastic basic question. So yep. I love it when you guys do that one.
So what to consider during times like these, and as you can see, all the red dots, we've had World War II price controls, Cuban Missile Crisis, the oil embargo, Black Monday, tech bubbles, GFC, the coronavirus outbreak. You see that little dip. If I was looking at the, and this is the S&P, this is from back in March. So if I had, and I don't, but I will for the next time, is have an updated graphic, which will actually see that the blue line is above from where this year started. So look, the one thing that I will say is the stock market has overcome past bears previously, and it will continue to do that because you're investing in the good quality companies, whether it be of Australia or whether it be around the world. And companies are in the business of making money. That's why they're in business. If they're not in the business of making money, why would they be there? And so therefore it is go and invest in those companies that are making good money, and be a part owner. And you know that in doing so, that your assets will increase over a long-term period. Don't let emotions lead you astray. And this is a good graphic because it shows you that, and I'll start with the irrational exuberance in the tech boom. So people were, 90, 98, 99 people were, oh, look, let's jump on. The stock market's going fantastically well. And then it starts to drop through the tech boom. And then you have the 9/11 and so on. And then all of a sudden the market tanks and, there's panic stations, as it says there. Things take off again and drop again. These things are going to happen. Okay. And the one thing that I will say is, and I know that Kat, Ian saw this with their, from a financial planning aspect, is the number of phone calls and queries that we took, I'd say from even December through to mid-February, in terms of people that have just called out randomly and say, hey, look, I've got some money I'm looking to invest. Okay, and look, that's all fantastic. But the question that we've actually, we've had to drill down on is that people getting in because they're just looking for a quick ride, or is this something part of their investment strategy that they're looking for a long-term plan? Because investing is part of a long-term plan. It's not something just to get in and make a quick buck. And don't put all your eggs in one basket. Diversification is key. So making sure that we've got assets across the different asset classes, and we certainly look at that from an investment committee point of view with the way that we invest our funds. So it is not all, as an example, Aussie equities. It is not all equities either. We will have some cash and fixed interest there just to provide buffers in the current environment. But the one point that we'll make is that we don't just put it all in the one basket and hope for the best.